All right, everybody, it's a couple minutes past the hour. Thank you, everyone, for joining. A couple notes before we get started. My name is Matt, and I'm one of the brokerage managers here at Penny Insurance. As we go through this presentation, if anyone has any questions that they need answered or any comments, please write them in the chat. I do have Chris here, who's also from Penny, to help answer those and to prompt me to ask those questions as they come up. So this is another one in our series of educational webinars that we're doing for agents to just help expand knowledge out there about different insurance topics. And today specifically, we're going to be talking about survivorships and really just how to unlock the power of survivorships, what they're used for, kind of some business case studies for them, and then also some tips and tricks to kind of position them with clients, type of clients to look for, and ultimately who does this product best suited for. Before we start, just gotta pitch a little bit about Penny for any of you that are not familiar with us. We're a independent IMO that is based out of California, although myself, I am in Oklahoma. A couple of other brokerage managers are across the U.S. And we service the full country, so we're a national IMO. Over 50 years of supporting people. We really focus on providing innovation, service, and results, and try to be very nimble as the markets ever change to be able to stay in front of trends and be able to help our agents and agencies really succeed in changing times. With that in mind, and with the focus on survivorship today, I wanted to introduce Mike Woods, who is not unfortunately on the call, but I did want to give him a shout out. He's actually an in-house underwriter for us, something that Penny has that not a lot of other BGA/IMOs have. So why is that important? Well, with large cases such as survivorship, when you're normally talking more complex, bigger premium, a lot more moving parts, you really want to get the underwriting down, place it in front of a carrier that you can get the first app in and completed, know kind of what ratings you have, and that's where Mike comes in. He's our in-house underwriter with over 35 years of experience in the industry. He has a relationship with all the major home office underwriting teams, including their leaderships. He routinely gets on calls, on panels, asked to come out to the carriers to really give input and learn about where they are, what they're doing, really in depth with what they're doing for underwriting. So that way, when cases do come in, he knows, what those underwriting teams are going to think in regards to a particular case to make sure that we can best position it for the carriers. He's a member of the Libra Underwriting Committee, and he's an accomplished chef. The guy, I've been told, has some amazing food. I unfortunately do not live in California, so have not had the chance to partake yet, but that is one of the first things when I go out to visit that I am going to be doing. So now for survivorships. We're going to cover kind of 4 key areas: estate preservation, business succession, charitable giving, and special needs planning. I'm going to cover them in reverse order, as I feel like as we go up the list to estate preservation, that's going to be the one that you're most likely going to have a lot more clients looking into. So I just want to cover these other aspects first. But we're going to meet the Johnsons. This is going to be our sample couple that we're going to take through this whole journey. Kevin, age 60, good health and a lawyer. Sandra, age 60, good health and accountant. So your average, family in their, 50s to 65 is where we see a lot of these cases starting to be placed, because that's when people are starting to think about legacy, taxation, and everything that kind of comes along with, putting a survivorship together. So for special needs planning, we're going to say that they have Zach. He's 35. He's independent. He's loved nature. He's a cashier. So he's able to sustain himself independently, but they still want to make sure that he is well taken care of. So they're going to use a survivorship to fund a special needs trust. That's going to allow for assets to be used as you intend. So the family is able to set up the trust, allocate the resources, kind of put the guardrails in place to make sure that Zach is going to be taken care of for his entire lifetime, once his parents, the caregivers, have passed. With it going into a special needs trust, it's going to help Zach qualify for other benefits. Since the trust is going to own the assets as well as the proceeds from the life insurance, those are not things that Zach himself owns. So that helps him qualify for Medicare, Medicaid, anything else, any other type of assistance program that he may need because the assets are being held in the trust. And it's going to provide the parents planning for Zach peace of mind that he will be taken care of. They're not going to have to worry about the money not being there when he grows older, not having enough money for buying houses, attending any schooling he wants, being able to provide for the basic necessities. Establishing that trust is going to give them that peace of mind, and having it in a survivorship allows them to plan it in a way that, once they pass, that trust is set up. I will note that I'm going to be covering a lot of these topics at a higher level. And the reason for that is when you start talking about the needs for a special needs trust, of course, we're going to need to have attorneys and stuff involved. We're not going to cover all the nitty-gritty details. These are more talking about the main aspects of what type of client is going to need for this, and then how to kind of position it so that way that this is something that they're going to want to pursue. The next thing we're going to cover is charitable giving. It's going to allow for the charity to be the beneficiary of the policy, which can provide a larger benefit than regular contributions. If someone really wants to fund a charity, whether that's giving the charity itself the death benefit, or providing a funding of a trust or other grant or fund to then continue to help support the charity, you're going to have a lot more leverage on your dollar by paying a premium of a survivorship policy and then allowing that death benefit to go to the charity. It does kind of push out your charitable giving a little bit since it is relying on you passing to pay that benefit. But for most people that are looking at this, they're looking to add that extra bit of oomph on top of the charitable giving that they're already currently doing, on a year-to-year basis. As I said, it can be used to fund a trust. And there is possible estate tax deductions for this. So the proceeds that are going to the charity can be taken out of the estate. This is something, once again, you're going to want to consult a tax professional on. But just note that the giving that they are putting in does have some tax implications for them and their heirs when the death benefit is paid. So now kind of into the two areas that I think that you'll find a lot more clients looking at survivorships and really kind of digging into what they need and kind of fitting that goal. And the first is going to be business succession. It's going to be able to help you facilitate a buy-sell agreement. So really giving the business owners a peace of mind that when they pass, that the business that they have, that the heirs will be able to be compensated without the business needing to be liquidated to do so. And that's really a key point with a lot of these succession plans, as well as estate preservation, is going to be the need to not have to liquidate in order to fulfill these types of goals. It's also going to help in estate equalization. So let's say Kevin and Sandra have two children, one that wants to continue in the business and one that doesn't. A survivorship will allow for that equalization of the estate so that one can get the business and the value of the business while the other is paid that death benefit. So that way both are treated fairly and equitably without the need of having to liquidate that business in order to pay both an equal share. So what does that look like in a little more detail? So Kevin and Sandra jointly own 50% in a law practice, Johnson & Smith, with a Tony Smith. Upon Kevin passing, his ownership stake passes fully to Sandra. So on upon Sandra's passing, Tony is paid the death benefit of the survivorship, and he uses that proceeds to buy out the 50% shares from Kevin and Sandra's children, Mark and Susan. So this kind of shows that example of using those proceeds as part of that buy-sell in order to compensate that next generation for the equity in the business that they are not taking part of. And the reason why survivorship works in this case versus other types of buy-sell is that Kevin and Sandra are joint owners of that 50%. So upon the passing of one, it doesn't negate the ability of the other to have that full stake in their half. And it really is upon that second passing that really there's a need for that buyout from their heirs. So we're going to start that estate equalization that we had talked about previously. So Kevin and Sandra now jointly own Johnson Financial Services. Apparently they have a lot of businesses that they own. So upon Kevin and Sandra passing, the business is given to Susan. The proceeds from the death benefit go to Mark to equalize the estate. And really what that means is that the Johnson Financial Services can stay as a full entity with each child getting a proportionate portion so that they're both treated equitably. If Johnson Financial Services has a valuation of $10 million, Susan's inheriting a $10 million business. Mark isn't getting anything because he's not part of the business. He'll get that death benefit to help equalize out the fact that he's not getting any stake in that business. This is just one of the many ways that a survivorship can be used. And it's one of the ways that you'll find that a lot of people, especially with businesses, have a need for survivorship outside of estate preservation. It's really the fact that you're trying to divide an indivisible asset, especially where someone may not want to take ownership of the particular asset, in this case, the business, from the other. You know, Mark doesn't want to work for the business or have ownership, so he's getting his buyout as part of the survivorship plan. So then finally, and this one is the one that we're going to focus a little more time on, and it's really going to be estate preservation. Now, I'm using preservation as opposed to estate plan, in other words, is because really for this type of client, they're really looking to preserve the assets that they have and allow their heirs to continue to have these assets without having to kind of foot that tax bill. So really that, like I said, prevents that need for that liquidization, and can also provide additional wealth to the beneficiaries. If the state tax liability is $7 million on what they have, and they have $10 million of death benefit, guess what? They're now being paid an additional $3 million split to your beneficiaries once that tax bill is paid. It also allows for the equalization of those indivisible assets. So anything like real estate, art, any other type of property, businesses, something that is not able to just be like, here's an account value, split it in half or split it in thirds or split it in however many. A survivorship allows for that equalization so that someone can get an asset and someone else can get a cash payout instead of having to sell off the asset to make everybody equal in that payment. And the reason for the survivorship and the reason that we're doing all this is because of the tax man. Everybody has to pay it. Even upon death, there is a need to pay it. And for 2025, there's a current exemption of 13.99 for an individual and 27.98, and these are millions for married couples. So if your estate is evaluated at over these thresholds, your heirs are going to have to pay an estate tax from that estate. So that goes back to that point that they don't want to have to liquidate assets to pay for this tax, which can be up to a current maximum rate of 40% on the federal side. Not to add on that some states may have an additional tax burden for those heirs. And in general, that federal tax bill does have to be paid within 9 months. There are ways to get some extensions and stuff and some additional filings, but Realistically, the taxman is going to come knocking in 9 months saying, hey, you have an estate valued at 50 million. We're taking off the 27.9. You now have an estate worth 22 million that's being taxed at 40%. We need a check for that money. And having that survivorship payment to pay for that tax bill really helps those heirs without having to worry about what is going to happen to the overall estate. I will note that gifts can deduct from these exemptions. So those exemptions listed above are without any giftable exemptions. Definitely speak to a tax professional if a client has been gifting and using some gift exemptions on what they'll do to the overall tax exemption. But realistically, when we're talking about taxes, they're not going to go away. What that amount may be could change. I know that the recent passing of a bill is going to peg it to inflation in the years moving forward, but that could get repealed. That could get a bill 20 years down the line that says something else. Taxes are going to be there. It's just going to be at what amount. What exemption are you going to have towards it? So really setting yourself up for that future tax bill is really what that estate preservation means with these survivorship policies. So people are going to ask, okay, great. Why am I going to get a survivorship policy versus just having some individual policies? So we're going to go over some numbers. We're going to have Kevin and Susan once again getting both a $10 million individual death benefit. These are UL products. We're looking at $212,000 and $174,000 for these $10 million death benefits at age 60 at their standard health. That survivorship for the both of them is coming in at 123, which you're going to think, why is it less than either of them combined? And it really goes back to how insurance companies really factor in that mortality. Men pass sooner than women, so which is why the female rate is lower. But now when you have a survivorship, you have both lives on the policy. So now both have to pass before the insurance company has to pay out. So because they now have two events that have to happen, that allows them to price this cheaper than it would for these individual policies at that same amount. So then I'm going to get the question of, okay, so they both have a $10 million policy. So instead of buying it each individually, they're going to buy $10 million each for a total of $20 million of coverage. So that $20 million of coverage is going to cost them each at the $10 million that we just looked at, $387,000. Well, good news, a survivorship at a $20 million death benefit is going to have that $247,000 premium, which is less than both of them combined. So even when you're looking at, instead of an either or, they're looking at, hey, I want both to be insured for 10 million to equal the 20, a survivorship may be a good way to position that to allow them to have that death benefit that they're looking for at a lower cost. And I will stress that with this and most survivorship sales, although there can be living benefits, there can be cash value access from a policy if it's on a whole life, an IUL, whatever it is. The reason why we focus on death benefit is that the clients that are purchasing these are not normally going to have to access the cash value of the policy. They're really setting up that death benefit for the future generations. They have access to cash within other means, other assets. And so they're not using this as that income replacement that you might have on a normal IUL sale. This really is more a death benefit driven sale and product versus having a cash value. So getting that death benefit at a lower premium allows them to use that money that they're saving to help build up their estate. So we're going to ask, who's this really for? Well, ultimately, it's going to be for your high net worth and ultra high net worth clients. Sorry about that. And it's really going to be because they're the ones that are going to have estates that are over these exemption values. Your typical family couple that has a couple Honda Accords in the driveway, a $300,000 house, and maybe has a boat. they're well under the estate tax exemptions. They don't need a survivorship in order to pay for those taxes. So this is really for the clients that really have those assets that really need to be protecting and have that evaluation that is much larger than what those exemptions are. It's also going to be for business owners. So as we showed before, it's a good way to allow for business owners to be able to uh, uh, equalize their share of the business when they pass with their heirs. I will note here that most survivorships are going to be sold on a husband, wife, a married partner type estate, but it doesn't have to be. You can have two business owners own a survivorship. There has to be that insurable interest, and that does make sense for a lot of business owners to say, okay, well, the business really needs to uh, uh, find a way to move on, to pay out once both these people pass, as opposed to either one. And ultimately, it's going to be for someone that values legacy and the protection of their heirs. They're the ones that want to have a name for themselves after to kind of live on. You want the clients that don't want to have to worry that the family home or farm or business has to be sold in order for the tax bill to be paid, or for everyone to get their equal share. So those clients that are really valuing that legacy and the ease of their heirs to continue in that legacy are going to be those clients that we're looking for. So when you're talking to clients, these are some of those key words that you're going to want to listen for in your conversations. And it's really going to be, once again, around that need for either avoiding the taxes, preserving the legacy, talking about how to, protect their estate. If they have large undivisible assets that they want to protect and want to keep within the family, as opposed to being sold off. And one thing that I'll note is that when the tax man comes. If something is not in place, you may have to sell assets on pennies to the dollar in order to pay that tax bill, because your timeline to sell them is reduced. So really, this is to protect the true value of that estate that they're leaving on, versus what that estate liability will be for that next generation. And you're going to hear some common objections. I'll just buy for myself. This is the one that I think you'll hear the most of. Okay, I'll just buy that $10 million policy on myself. As we already saw, allowing that to be a joint policy does make it so that the actual premium for them will be lower. But there's another thing to consider here that I think is sometimes lost. Husband and wife have a $10 million policy each. Husband passes, the $10 million gets paid to the wife. Guess what? She now has $10 million more in her estate. Sure, she got that benefit tax-free, but now when she passes, that's now a bottom line number in her estate that her heirs are going to have to pay tax on. So although the transfer of wealth between married partners may be an unlimited exception, the fact that once that death benefit is paid and now becomes part of the estate is a good reason to position a survivorship versus just buying for yourself, because you're hoping you're the one that outlives your partner. Another thing that people are going to say is that I'm going to be under the tax exemption. Great. For someone, like I said, that may have, that $300,000 house, have, two, mid-sized family vehicles, that might be true. But for anybody who's growing and building their net worth, while that may be true today, you need to talk to these clients about, well, what do you think the valuation of your estate is going to be 20 years from now? You're showing that you've grown this much over the past 10 years. What's your estate going to be valued in 10 years from now, 20 years from now? Are you still going to be under these exceptions? What if the exceptions drop lower? What if your estate outpaces inflation, which you would hope that it would? And you really want to talk to them about the fact that even though they may not have a need for it with their current evaluation now, if they're close to those markers, this is a future conversation of protecting their future selves. And the best part is it's still a life insurance product. If they don't have any estate tax needs, guess what? The heirs now have that full death benefit paid to them without the need to pay that tax if they are under those estate tax exemptions. You're going to hear another one, I'm uninsurable. Great. One of the best things about survivorship policies is the fact that for a lot of these policies, in fact, most of the ones that I'm aware of, you can have one uninsurable on the policy as long as the other one has insured. I've actually seen some cases written through a carrier that I used to work for that had an insurable and someone at a table 6. Now that premium was a little much, but they were able to still capture protection while including both of them in that survivorship policy. So the fact that one may not be able to kind of pass the underwriting muster, you can still position them in a survivorship product as long as one of the two parties is going to be insurable. The next one is, what will I leave for my partner? So part of this goes back to that I'm going to pay my partner the $10 million and then they're going to pay the taxes after. It's really about the discussion of what is it that we need for that next generation, and these are going to be clients that are not necessarily worried about their partner being taken care of once they pass because they have other assets. And that's really where, as a financial professional, you're going to have to know what other assets that they can lean on above and beyond survivorship in order to do that. But another good thing about life insurance, you can have more than one policy. So I have seen cases written where there's a survivorship for the estate, but the estate does include individual policies on both people on the survivorship. And so, as we said before, that 10 million now gets added to the estate when it's passed on. That's accounted for in their evaluation and what they perceive to be the tax need that's going to be covered by the survivorship. So it's not you have to choose one or the other. The survivorship is really about that generational transfer, not necessarily that partner to partner. And then the last thing is, my children will just sell the assets. Great, but when you have that tax bill, you're not going to get the full valuation of the assets that you may think. And that's something that is going to be a hard pill to swallow for a lot of clients. They have their house that they have, it's a $15 million property. If you look through a lot of listings, how many listings do you see that are multi-million that have been sitting there for years? And if the heirs can't sell that within a reasonable time at the full value of the property, they're going to be taxed at the full value because it's part of the estate, but they're going to have to sell it for, like I said, pennies on the dollar in order to pay that tax bill, and now they've just lost wealth. So it's really a talk about that preservation that we talked about, and that ability for them to think, okay, great, they may have some assets that can be convertible to cash, if you have, stocks, bonds, and other, but for some of those other intangible or harder assets, you're not able to as quickly turn those around in a manner that you're going to get that full evaluation that you're being taxed on. So it's really something to think about of, sure, your children can just sell the assets, but is that even going to give them enough for what they need to cover? So I know that was a lot to talk about. I've been talking for the past 25 minutes or so. I'm going to leave it now for any questions. As I said, these are some more complex cases, and we here at Penny are happy to help. If you have one of these, help you through the underwriting process, help you pick out a design, help you kind of talk through some client needs and scenarios as they come up. We are definitely happy to help assist with that. But you're going to want to make sure that for a lot of these, there is a tax professional involved. If there's any types of trust that need to be set up, you do have trust lawyers, same with the buy-sell. So just note that for a lot of these, it's not going to be someone walks into your office and then you sign an application the next day. These are going to be some longer sales, but I do think that they are some worthwhile sales. And if you're lucky enough to find these, they can definitely generate some huge potential for yourself and your agencies. So any questions on what we just covered?
So I actually have a question on my end. What are
Yes.
some of the biggest mistakes you see agents making when introducing this to their clients?
I think, like I kind of talked about before, is they focus more on what they typically sell life insurance for, that those living benefits, the cash value within the policy, setting yourself up for retirement, having some for the next generation. For survivorship, it really is talking about that next generation and that preservation of wealth. So for the clients that you're going to talk to about this, they already have other assets. They're not looking for potentially another policy, and if they are, that's a separate policy from the survivorship. When you're talking survivorship, it really is going to be that death benefit focused sale that's going to talk about how are you going to position the next generation to succeed and pass that on versus a current generation and covering the mortgage, providing income for retirement. Those are sales that I find a lot of agents kind of get trapped into, knowing those talking points without realizing that they have to pivot when you are talking about survivorship cases to um, a bigger way of thinking, and to really understand that the client's really looking for that protection portion of the life insurance versus that protection slash cash value that you may be normally used to selling on your day-to-day interactions.
And kind of like a follow-up to that,
Mhm,
say I was introducing this to a client,
mhm.
what are some of the key points that I should focus on to really sell it?
It's really going to be about that estate preservation. You're going to really want to talk to them about the fact that it is a second to die policy, which is another name for it. And it's really going to be that once both pass, what's going to happen for that next generation. So the key points that you're going to be focused on is, what are you looking to preserve in your estate? Whether that's a business, whether you want to fund a trust for special needs or want to donate to a charity. What is it that you're looking as a legacy versus what are the immediate needs that you may have, like I say, in those other sales of, okay, we got to pay off the mortgage, we got to fund the kids' colleges. This is more a legacy sale. So keying in on those legacy points and showing how survivorship is going to be able to, however much their evaluation is, uh, uh, just some quick things on kind of, whatever they value their estate is. Ask them, what are you going to evaluate your estate 20, 30 years from now when you're actually going to be passing? Okay, what's that number going to be minus the proposed exception, 40% tax bill? This is what we need to secure in coverage in order to pay that tax bill. Now, once we find that number, are you going to want to add any additional to add to that generational wealth building? And that's really how you need to position it, is talking about that legacy, that next generation, that preservation of current assets by paying off that tax burden that you may have, or conversely, um, uh, having that preservation of that peace of mind of, funding a special needs trust or making sure that your money goes to the charity that you really want, and those contributions. It's really about that legacy and that peace of mind of their money working and their assets working how they want once they pass.
And how can agents avoid overcomplicating this, especially like if they're working with clients who aren't financially sophisticated?
So I would say that the best way to not overcomplicate it is to just ask them simple questions. And this is your normal fact finding of, what do you value most? Are you looking to have a legacy? And it's really going to be for the clients that this kind of makes sense with. They should be at least somewhat financially savvy, or they should have somebody that is financially savvy, that is part of their circle, that you may want to get involved with this. And that's one thing that I find that agents sometimes miss, is not including all relevant parties in the conversation. When you're selling a survivorship to someone that has $100 million estate, you're not just selling it to the client, you're selling it to their tax attorney, their lawyer, their financial advisor, if that's not yourself. There really are other parties that need to be involved, and identifying who those parties are early, and getting kind of everyone at the table, not necessarily all at once. You can have these conversations separate, but really understanding that if the clients themselves are not financially savvy enough to understand the need for that estate protection, somebody in their inner circle is, and that's who you want to also loop in. Once you kind of get the clients hooked on the idea of this is a product that is going to help protect that legacy that you've spent a long time building. And that's really kind of one of those key points, is that protection of that legacy. If someone spent the past 50 years, going from zero to hero, as they call it, they were poor, now they own 20 businesses, and they did it all themselves. Well, you want to protect that legacy. This is how you do it. So really having those generational concepts, and understanding that if the client's not financially savvy enough, to bring someone in once they get hooked on the idea of this is how you protect that legacy. That's really the selling point to the client, is that legacy protection.
Gotcha. Yeah, thanks so much.
Mm-hmm.
So my last question is, if anyone does have any questions, how do they get in touch with you? What's the best way?
So I probably should have had my phone number and email up. I will do that right now. Give me 1/2 second. Let me just stop sharing. But if you contact us at Penny, myself or any one of the other brokerage managers will be happy to assist. But for myself, and let me just share this real quick. I probably should have had that in the presentation, so I apologize that it's going to look a little odd right now. So phone number direct to me, 916-960-8723, M Gantner, Gantner at Penny Insurance. But really, if you contact Penny Insurance through any of our means, it can get routed to myself or one of the other brokerage managers, and we all are willing, able, and happy to assist you with these cases. And we understand that these cases take some time and do have a lot of moving parts, and that's what we're here to help support with, making sure that you're able to position this in the best way and able to keep the client engaged and moving forward as they go through the entire journey to get this type of insurance purchased.
And we will be providing everyone with a copy of this webinar. If they missed anything or just want to view it again, we'll send it within 24 hours to everyone who registered. So there doesn't look like there are any questions that I'm seeing in the chat.
Okay.
So at this time, just wanted to thank everyone for joining us today, and hope to see you next time.
Thank you, everybody.